Hello, I'm Shaun Richards of Not a Yes Man's Economics. My subject of today is interest rates. This week has seen an emergency interest rate cut. We may yet see others. How does this work? What's changed? If you look at the screen, you'll see that on the picture, we've seen interest rates now in the United States cut to, 1%. The range is 1% to 1.25%. Somewhat breathtakingly, if you look at the first sentence, it says the US has a strong economy. Well, that's plainly not true, or they wouldn't have done it. But this is quite a change from a year, 18 months ago, when the US Federal Reserve was talking of things like normalisation. What do they mean by that? Well, that would have meant taking interest rates up towards 3%. So as you can see, they've been forced into quite a reverse here. And there's a second factor to this. You see, once you move in this manner, with an emergency style move, markets will just expect more. So when we come to later this month and they have their meeting, then another 0.5% will be expected. So suddenly, US interest rates could be below 1%. And that is quite a shift. Why? Well, the United States is one of the few countries in what we might call the first world that's resisted the trend towards what's called ZIRP, zero interest rate policy, where so many places either have zero interest rates, some cases below it, or just above. Now, it's being sucked back into what you might call a supermassive black hole, and there doesn't seem at the minute to be much of an escape. The next question is, will others join it? Well, there are various rumours that they will have done already, so that places in a difficult situation. What about the European Central Bank, for example? That has enough issues by the fact that its interest rate's already negative at minus 0.5%. A little more scope in my home country, the Bank of England, with interest rates at 0.75%. So it has a little scope to cut. But then there's a more fundamental problem to all of this. We've had lots of interest rate cuts around the world, 745 to my best count in the credit crunch era. So where does that take us? We've had so many. If that fixed things, then why are we now where we are? Because you see, this isn't just the coronavirus. Obviously, it'll make changes. For example, we've seen this week Chinese car production fall by 80% in February. Germany seems issues around car sales down 11%. So there's a lot of factors at play weakening the economy, but the real issue is that it was weak in the first place. We hadn't seen a lot of growth, and now suddenly, not only does that look like it's disappearing in China, for example, and in other places around the world, but we might see more than a few actually having a contraction. And if there's one thing that all the central banking moves of recent times were designed to avoid, that was the economies contracting again. So they find themselves now in quite a difficult situation. Not much room to cut interest rates, what they most fear arriving. So what can we expect next? Well, if we move to a consequence of all of this, the fact is now bond yields are extremely low. We've seen for the first time ever the US 10-year yield go below 1%. So even for the United States now, it's extremely cheap to borrow, which makes things like fiscal policy very cheap. Used to be arguments at the opening of the credit crunch that there would be things like bond vigilantes and it would be very expensive to borrow. But we actually find now that we're in a situation where it's very cheap. So I expect that to be the next move. Thank you.